investors weigh a new batch of economic data, including a key inflation reading on Friday, PCE. Joining us now is Tom Hainlin, U.S. Bank Wealth Management Senior Investment Strategist. And Tom, let's start with some of that econ data that we got this morning, in particular, continuing claims, that number hitting the highest level in more than 2 years. Do you see this as a normalization of the labor market, or is it an indicator that higher rates are hurting the U.S. economy?
Yeah, thanks, Alexander. We saw the data this morning. It suggests that the Fed's rates are having an impact on the economy and in the way that they are anticipating, which is kind of gently slowing the labor market, gently slowing investment and economic activity so that they can go ahead and move forward then moving forward to interest rate cuts perhaps in the second half in the fourth quarter of this year. So that was kind of almost like a bad news is good news type of economic print this morning, where the numbers weren't so bad to suggest that we're having a sudden contraction in the economy, but that these rates are starting to have an impact.
Tom, as I read through your notes, you sound constructive on the stock market, Tom, but maybe, the vibe I get is kind of cautiously constructive. Am I reading that right, Tom?
Yeah, Josh, if we look at just the kind of the pillars of growth, inflation, and interest rates, even though the data was a little soft, it's still a positive economy. Inflation will get a new reading tomorrow on the PCE, as Alexandra alluded to. We have positive but decelerating inflation, and Treasury yields have kind of stabilized here around 4.25. We think that's a pretty good setup for stocks to price higher, at least at the broad index level. And then, as you mentioned earlier, in terms of performance, we still think those secular growth, large cap tech names are still likely to carry the market forward, just because that's where you see the greatest visibility in terms of sales and earnings growth. But we pair those technology-oriented investments with some additional sectors, like those dividend-paying sectors, like consumer staples and some select healthcare names, and some of those like non-office real estate sectors, where if you do get rate cuts in the second half of the year, you get some less competition from Treasury yields, and that kind of helps those dividend payers look more attractive.
So, Tom, in terms of portfolio positioning, considering that there are some overhanging risks, we don't know if and when we are going to be seeing those rate cuts, would you advise your clients to be more offensive or defensive at this point?
Yeah, Alexandra, our recommendations have been to kind of tilt more towards those positive growth and inflation-sensitive assets. So for a typical diversified investor, they've got some allocations to stocks and bonds and things we call real assets. We would have some of that money out of core bonds and into those U.S. large cap equities, but also pairing that with things like inflation-protected bonds and commodities. Again, inflation's coming down, but it's still above the Fed's target rate. It's still positive, and typically those assets tend to do well in that scenario.
Tom, I want to get your take on the AI trade as well, which of course has been a big theme for investors. Micron, reported last night that stock, roared into that print, Tom. I mean, investors just bet that was another name that was going to benefit from this mega AI trend. It's getting hit today afterwards. Just as a strategist, how are you thinking about that trend, Tom, and how do you want to invest in it, if at all?
Yeah, Josh, we still see AI in this discovery phase. And so the ultimate demand for all the feedstock into it and the semiconductors and the cloud and the kind of the overlay of the user interface, that's still in play in terms of how many industries and how many companies see a productivity benefit in that. If we look at early in the kind of the robotics and automation phase, it took a while to figure out that was going to move into everything from the primary economy like mining and farming, all the way into medical devices, robot-assisted surgeries, and into the home in terms of like robotic vacuums. So we still think that AI is in an early stage of discovery of what it can do and what the ultimate users will do with it in terms of productivity. That will help determine ultimately the ultimate opportunity set there. So we still think it's early. We still think there's room for those assets supporting the AI investment continue to run. But again, in order to be a little bit more defensive, we would pair those again with some of those more dividend-oriented opportunities, just to give you a little bit more ballast in that equity portfolio.
And Tom, we have a little thing coming up in November, the U.S. election, but we're seeing markets significantly outperform typical election years. Given that, do you view the election as a potential risk to stocks, and how should investors be positioning their portfolio ahead of November?
It's a unique setup, Alexander. I think this is the first time since in the post-war time when we've had a debate occur this early in June, you typically go through a process of the conventions and the nominees, and you start to see the platforms from each candidate, and then you have a debate to kind of flesh out the differences between the candidates. So definitely a unique setup for this evening's debate. The work we've done at US Bank, and we published it, you can find it doing a web search for how elections impact markets, is we still find a much more significant impact of that setup of growth and inflation and interest rates than ultimately which party resides in the White House or has control of either House of Congress. So we think this is still a good setup for stocks leading into the election. And typically you do have positive performance on election years where you have a candidate up for re-election, as is President Biden. But again, the path forward for the stock market is more likely to be determined by how does economic data come in? What's the Fed path around interest rates? Is inflation coming back to target? And that'll have a much stronger influence on capital market performance than perhaps the outcomes on November 5th.
Tom, we'll get you out of here on this. For fixed income investors who are listening right, Tom, what's your guidance? What's your advice to them?
When we say we're tilted towards equities and real assets, it doesn't mean we don't like fixed income here. We still think clients should have a healthy allocation there. Within the fixed income, the bond market, we still see opportunities for clients that don't pay taxes for those sort of institutions. We see areas around those part of the mortgage market that's not backed by agencies. Home prices are still strong. Home owners are still having supported by a strong labor market and wage growth. So those non-agency mortgages within kind of those idiosyncratic areas of the bond market. For taxable investors, we still see a lot of value in municipal bonds and being able to go out in maturities, taking that extra yield that you get, and also high yield municipal bonds where default rates are historically pretty low and investors can earn additional yield there.
Tom, always good to see and have you on the show. Thanks for joining us.
Josh, Alexander, thank you so much.